Let's now quickly revise Accounting Standard 19, which talks about leases. To begin with, what is a lease? Lease is an agreement between two parties. Who are the parties to agreement? One person is called lessor and the other party to lease is called as lessee. The agreement is to transfer an asset. Lessor is the person transferring the asset. Lessee is the person who is calling the asset. So lessor transfers the asset to lessee. Whenever he's transferring, he'll prepare one document writing that I am giving the asset to you for a consideration that you would have to give me, and that becomes a lease. So lessor transfers the asset to lessee for the consideration to be given by lessee to lessor over the lease period, and that becomes a lease. And actually, there was no need for a big standard like lease. The problem started when people started fabricating sale transactions into lease. To overcome this kind of a problem, which needed a lot of accounting discrepancies, the standard brought into picture just to divide the leases into two categories: operating and financing, where operating leases are actually genuine lease transactions. Finance leases are nothing but sale transactions, sale of asset on credit, but pretended to be like a lease transaction. Because people started pretending it as a lease, government prescribed a separate accounting for that kind of lease, which is actually not a lease but a sale, but pretending to be a lease. You'll understand slowly. I'll help you people. Certain things that you should know: it is scope. The standard does not apply to exploration of natural resources, mining, ore, natural resources. When you take AS19 is not applicable. And if the licensing of these videos, plays, motion films, you give a movie to Amazon Prime and all of this, so that kind of things, no, accounting standard 19 lease is not applicable because they are intellectual properties and intangible assets. And next, for use of land also, again, AS19 is not applicable because land usually has indefinite useful life. And for lease purpose, you should have an asset with definite useful life. So AS19 doesn't apply here again. There are two categories of leases. One is finance lease, second one is operating lease. A lease where substantial risk and reward is transferred by the lessor to lessee is finance lease, basically sale. Substantial risk and reward is transferred. You remember AS9? We discussed the same thing. If the substantial risk and reward against an asset is transferred from lessor to lessee, it is finance lease. If it is not a finance lease, it is operating lease. Operating lease is giving an asset on rent. Finance lease, in short, is sale of an asset. Finance lease, in short, is sale of an asset. And in order to call a lease as finance lease, it should be non-cancelable lease. Meaning what? It should not be cancelled. So cancel madangilva? No, it should be cancelled only by a remote contingency. It should be cancelled only at option of the lessor. It should be cancelled in order to enter into new lease with the same party. That is basically making it non-cancelable. Then how do we classify a lease into operating lease or finance lease? These are the conditions. It is not like one out of the three conditions are fulfilled, two out of the five conditions. There is no one out of these many. You need to judge them professionally. What are the conditions? Number one, lessee will get ownership of the asset at the end of the lease. Lessor is the owner. No, lessee is only user. When the lessor gives the asset to lessee to use it, lessee should use the asset and give it back. At the end of the lease, if the lessee is having a right to buy the asset, then it is actually not lease only, it is sale. Am I right? During the lease period, asset is with lessee. After the lease period, asset will be with lessee. Then where is lease? It is sale. You fabricated to look it like lease. So the primary condition is lessee, if he has an option to buy the asset at the end of the lease period, then it is finance lease. Next one, lessee has an option to buy the asset at the end of lease, but not like others. Let's say you are lessee, I am lessor. I have given the asset you on lease for 5 years. At the end of 5 years, if I take the asset back from you and give it to somebody else, they will give me 10 lakh rupees. But I am giving the asset to you after 5 years, not for 10 lakh, but for 2 lakh. Why is it that you're getting it at a price lesser than 10 lakh? Maybe because I've already collected enough money from you. Maybe because other than you, nobody else can use that asset. Maybe because that asset is designed for your usage only. Or maybe because the asset's effective useful life is over at the end of the lease. Meaning, I have not given the asset to you on lease. I have sold the asset to you, but fabricated to make it look like lease. So primary condition number one, lessee has an option to buy the asset at the end of lease period. Condition number two, lessee will buy the asset at the end of the lease period at a price lesser than fair value. Fair value means arm's length price. In an unrelated market with an unrelated party, on whom I don't have undue influence or coercion. At what price will I sell? If I am selling to the lessee at a price lesser than that, then it is finance lease. Come to the third condition. Lease term covers major part of the life of the asset, or we can say lease term, the period for which I have given the asset on lease to you, covers substantial period of the useful life of the asset. When we say substantial period, there is no 90%, 20%, 50%, 60%. It is pure professional judgment. And just based on one condition, we cannot tell finance lease or operating lease. We need to see all the five conditions, and based on all the five conditional numbers, we need to come with a professional judgment. Yeah. Usually there is a misconception. I don't know where and how does it start, but people start telling 90%, 75%. Please slowly refer the questions in the past. There are questions where useful life and then come part of lease has come to 74%, 73%. Still, it is considered as finance lease. So it is no rule. Counting standards itself is basically not rule based. It is always principle based. This is one part. The useful life of the asset, whatever is there, no, major part of its useful life, it's on lease. If it is on lease for major part, it is finance lease. Got it? Basically, after the lease, lessor doesn't have a point of taking that asset back. Why? Asset is dead already. Meaning, entire useful life, it's on lease only. So actually, I did not give it to you on lease. I sold it to you, man. Do you agree with me? Very nice. Come to the next part. Present value of minimum lease payment. I am lesser. You are lessee. You have to pay me money. I am lesser. You are lessee. You have to pay me money. The money that you're supposed to pay me as per the agreement is called minimum lease payment. Minimum money, what you should pay to me is minimum lease payment. How do we have to pay money? You have to pay money in two forms. One, every period, at the end of each periodic payment. We call it periodic payment. That is lease rental. Second one, you have an option to buy. No, because you have an option to buy. If you agree to buy, you promise to pay me some money. That and this together is minimum lease payment. You have agreed to pay periodic payments and you have agreed to pay some money at the end to buy the asset. So lease rentals plus residual value guaranteed by lessee. Lease rentals plus residual value guaranteed by lessee. Putting it together will form the minimum lease payment to be made by lessee to lessor as per the lease agreement. And this you would not pay me today. You would pay first lease rental at the end of first period, second lease rental at the end of second period, third lease rental at the end of third period. It is periodic payments that you would make. These periodic payments, I would have to identify the present value of these future payments. Today, if you're making me 1 lakh rupees lease rental payment for 5 years at the end of each year, today's value is not 5 lakh. At the end of year 1, I get 1 lakh, not today. At the end of year 2, I get 1 lakh. Year 2, if it is 1 lakh, year 0 beginning, how much is it? We will discount it to find it. So that is the reason we take PV, present value of the minimum lease payment that I'm going to receive in the future. That should form substantial part of the cost of the asset. That should form substantial part of the cost of the asset. The mindset that you would have to have here is keep lease aside for some time. I am lesser, you are lessee. I have sold the asset to you, but you are not paying the money to me immediately. You will tell you will pay it in 5 installments. I will charge you interest. Interest is my income which should go to P&L. The money that you paid for the asset should be my cost of the asset reimbursement. Am I right? Let's say you're paying 1 lakh, 1 lakh, 1 lakh 5 times over 5 years. You get it? So I will say 1 lakh, 1 lakh, 1 lakh is principal plus interest, principal plus interest, principal plus interest. Let's say the cost of the asset is about 1 lakh. I'm telling today if you pay 4 lakh and take the asset. If you are paying in installments, I want you to pay 1 lakh every year for 5 years. In that 1 lakh every year, if you pay 5 lakh, if you pay 4 lakh is the cash price, you pay 5 lakh, 1 lakh is interest. That interest income, I don't earn it in the beginning of year 1. I earn it at the end of year 1 little, at the end of year 2 little, at the end of year 3 little, at the end of year 4 little, and balance money at the end of year 5. So to me, 4 lakh is the amount that I'm supposed to recover from you right now for the asset. 1 lakh I will charge you extra because of delay. This 1 lakh is my finance income. At the beginning of year 1, this 1 lakh is unearned finance income. Why? I will earn it eventually over the period. So I should record your receivable at 4 lakh. Basically, that's what I'm trying to tell. You eliminate the interest portion, identify the price at which you sold the asset. That price at which you sold the asset is nothing but minimum lease payment that you would have to pay to me. That is lease rentals plus guaranteed residual value promised by lessee to the lessor in the lease agreement discounted to the first day is present value of MLP. If the present value of MLP is forming substantial part of the cost, again, why are we comparing it with the cost? Very simple. Present value of MLP is the money that you're paying for buying the asset. If you paid me almost entire cost of the asset, then it is finance lease, basically sale. You get that? Again, here substantial means there is no definition. 60 can be substantial, sometimes 70 might not be substantial. We'll see all the considerations together. There is no percentage mentioned anywhere in the standard. I hope you people got that. Then the last one that we have is asset is of specialized nature. Asset is so specialized that only and only you can use. Other than you, nobody else can use it. Only and only you can use the asset, not nobody else can use the asset. Then even after the lease period, I don't have an option. I have to give the asset to you only. I can't sell it to anybody else. It is as per your requirements. That is, asset is of specialized nature. If the asset is of specialized nature, then the lease is finance lease. There is no one of these conditions, two of these conditions, and three of these conditions. Check all the conditions based on professional judgment. You decide it. You guys got that? What are the 5 conditions? Lessee has the right to buy the asset at the end of the lease period. Lessee has the right to buy the asset below fair value. And then major part of the useful life of the asset is covered by lease, and present value of MLP covers the cost of the asset. Major part of the cost of the asset is of specialized nature. If these conditions are fulfilled, it will be finance lease. Understood? In the case of finance lease, as a lessee, you pay me lease rental, which is periodic. You pay me residual value, which is at the end of the lease period. Lease payment is periodic. Guaranteed residual value is at the end of the lease. Guarantee can be given either by the lessee or someone on behalf of the lessee. Either it can be guaranteed by the lessee or someone on behalf of the lessee. Sometimes lessee does not guarantee. Lessee will tell, let us see. That day, if I feel like paying so much, I'll pay. That will be not guaranteed, but still believed to be residual value of the lessor. Lessor has asked, lessee has not agreed. You are telling at the end of the lease, you will pay 2 lakh rupees for the asset. I am asking 5 lakh. I have told 5, but you agreed only 2. So according to lessor, residual value is 5. According to lessee, agreed and guaranteed is only 2. So 3 lakhs, what the lessee has not agreed, but lessee still believes, is unguaranteed residual value. Whenever you do any accounting from lessor's perspective, you will do MLP plus GRV plus UGRV. Whenever we do any computation from lessee's perspective, you will do MLP plus GRV. UGRV will not be considered. Why? You did not guarantee. Why will you consider? I am still feeling that I'll receive it in spite of no guarantee. So I will consider the same. So minimum lease payment is the money that you have promised that you will pay. What have you promised to pay? You promised to pay lease rental plus guaranteed residual value. If I take present value of it, present value of MLP, that will be the point of discussion. And then comes another point called as gross investment. Gross investment is basically money that I am expecting to have been invested on that asset. I am supposed to recover what you pay plus what you have not promised to pay. What have you promised to pay? MLP plus GRV. What am I thinking I'll receive over and above that? UGRV. Add UGRV to it, it will become my investment. What investment? Gross investment. What is my investment? So what is your MLP? Lease rental plus GRV. What is my investment? MLP plus UGRV or lease rental plus GRV plus UGRV. So that's from my standpoint. To you, you are not supposed to pay MLP right now. Your liability right now is present value of MLP. What is your liability? Present value of, when you record your liability towards lessor, you will record it at present value of MLP. When I record my asset, I will record it at present value of gross investment, including unpromised, unguaranteed residual value. And this present value of gross investment is nothing but net investment. And difference between gross investment and present value of gross investment, the difference is there, no? That is the interest income that I will earn over the lease period. At the beginning, I have not yet earned, so we call it unearned finance income. What do we call it? Unearned finance income. So quickly see it. This is how it will look like. Gross investment is total lease rental plus guaranteed residual value by lessee. If you add these two to this, if you add unguaranteed residual value, it will become gross investment. And net investment or present value of gross investment is present value of all of this, present value of lease rental, present value of GRV, present value of UGRV. You get present value of net investment. To take difference between gross investment and present value of gross investment, you actually get finance income. I don't want you to follow this format. I'll tell you, you just have to write year 1, 2, 3, 4, 5. Lease rentals, you write here, add GRV. You get GI. And then add, you get MLP. Add UGRV, you will get GI. You'll write present value factors here and then multiply, take the total. GI is here, present value of GI is here. Different will become finance income there only. So you don't have to use any formula in accounting standard 19. Everything happens just by table. But this I thought it you just for you to know. And the point for discussion is parties to lease agreement. Let's see the one who receives the asset. You should record the asset and liability. Asset is lease asset what you got. Liability is money that you owe me. Liability is the money that you owe me that you would have to pay it. So you record the asset and liability at least of these two things. One, fair value of the asset at the time of inception. Basically like cash price of the asset. If you say lease you beda, yenu beda, I will give full money. Give me the asset. What money do you want? If you ask, I'll tell one price. No, that is fair value at the time of inception. Or present value of MLP. What is present value of MLP? Money that you signed in the agreement to pay. But the money that you sign includes interest. From that, if you eliminate interest element by discounting, what arrives is present value of MLP. So you owe me present value of MLP, correct or not? And the asset cash price would be fair value at the time of inception. You will take whichever is less. At that value, you will record your asset. At that value, you will record your liability. Are you getting it? And over a period of time, you go on adding interest and then you will pay the periodic installments. You being a lessee, you don't have ownership of the asset. I am the owner. But still, you get to charge depreciation because of substance over form. And lesser, I have a receivable from you. I will record it at present value of gross investment. That is basically net investment. Lease rental plus guaranteed residual value plus unguaranteed residual value. I will discount it to today's date and I'll record it in my books. And based on that, I'll book my finance income each period. You will book finance expense, I'll book finance income. This is finance lease. Let's now see operating lease. Operating lease is something very cool here, easy. Whenever you pay lease rental, to you it is expense. Whenever I receive lease rental, to me it is income. I am the owner of the asset. You are not the owner of the asset. I will record the asset in my balance sheet. I will charge depreciation. You will not charge depreciation. Who am I? Lesser. Operating lease ali, lesser will record the asset, lesser will charge depreciation. Lessee will not charge depreciation. Lessee, whenever he pays the money, to lessee it is expense, to lesser it is income. Now we'll come to the most beautiful part of the standard, which is sale and leaseback, which is actually very easy. You don't have to break your head at all. What is sale and leaseback? Sale and leaseback is where I am not wise at the beginning, but later I become smart. I'll repeat. At the beginning, when I raised enough money, I should have taken that money for working capital management and I should have bought the asset on rent. I should have not purchased the asset because buying the asset on lease or rent is an ideal thing. You don't have to show the asset in balance sheet. You don't have to charge depreciation. You don't have to put huge investment. Basically, you charge you pay the money in installments. That is the advantage. But unfortunately, what have I done? I purchased the asset. I did not take it on lease. I purchased the asset. After purchasing, all my cash is out. Now I am feeling the pinch. Oh my God, I don't have money to do my business. What would I do now? I'll find one rich guy, sell the asset that I have to that rich guy, and take the asset back from him on lease. He actually doesn't want the asset. He doesn't even see the asset. We signed two documents. Document number one is signed to sell. I sell. He buys. The moment he buys, we flip the page and then write one more agreement. This is for lease. He is giving it back to me on lease. I'm taking it back from on lease. Basically, in this case, I'm taking loan from him, giving the asset as pledge, but I won't call it loan. I'll call it sold, taken back on lease from the same person. Now, when I sell the asset, I'll make profit or I can make loss. That profit or loss, how is it is to be recognized? This depends upon what is the kind of lease I'm getting it back from him. When I sell the asset, I'll make profit or loss. When I take the asset back on lease from him, what kind of lease is it resulting? That will decide the kind of accounting should be done for the profit that happens on the sale. If the sale and lease back only, reverse lease is finance lease. Finance lease means what? Keep this lease back asset. Think of what we discussed in the beginning of this and tell me what do you mean by finance lease? Purchase or sale. Am I right? So I'm taking the asset lease from him. Basically, I'm purchasing the asset from him. Am I right? I am lessee. Who am I? Lessee. He becomes lesser. First, I am owner. I become seller. I sell the asset. He becomes buyer. He becomes owner. That owner will become lesser. He will give the asset to me on lease. So first I sold. Then I took it on finance lease. Finance lease is like purchase. I sold it. I bought it. I sold it. I bought it. Weird, no? When I sell it and then buy it, no? That profit cannot arise. Profit cannot. Why I sold it? Let's say I made profit. 1 lakh is the cost of the asset. I sold it to him for 1 lakh 20. I made 20,000 profit. He will give it at least back to me, no? Now, why did he pay 20,000 extra? Why did he pay 20,000 extra? If he paid 20,000 extra, later when he gives finance lease to me, he will recover that 20,000 from me extra. Asset book value is 1 lakh. I'll sell it to him for 1 lakh 20. I'll make 20,000 profit. You know, why did I sell it to him for 1 lakh 20? I want 1 lakh 20 cash. Like, sir, 1 lakh 20 you give. He's like, hey, asset value is 1 lakh. I'm like, give 20,000 extra. I will take the asset back from you on lease, no? If it is somebody else, I would pay 10,000 lease rental. You take 12,000 rupees from me. Take 2,000 extra for every year for 10 years and take the money. So he will give me 1 lakh 20,000, 20,000 extra. And he will recover that from my finance lease payments that I'll make later. So whenever I get that 20,000 profit on sale of the asset, that should not be recognized to P&L immediately. That should be deferred and amortized over the lease that follows. Transaction number 1. I am having an asset of 1 lakh. I sell it to him for 1 lakh 20. He buys it for 1 lakh 20. He gives it to me on lease. Now when he returns, gives it to me on lease, the lease period is 10 years. Cost of the asset 1 lakh, sold for 1 lakh 20, 20,000 profit by owner. That 20,000 profit by owner should not go to owner's P&L account immediately. It should be written over 10 years, every year 2,000, 2,000, 2,000, 2,000, 2,000. That's what this says. See, when the asset is sold and leased back, lessee, owner before sale, continued as user even after sale, might make profit or loss on such sale. Treatment of such profit or loss depends upon the type of resulting lease. If the lease is financing, profit or loss on sale between carrying amount and sale price should be deferred and amortized over the period of lease in the proportion of depreciation. If I sell the asset to him, I am the owner, I sold, I became seller, he bought the asset, he became buyer, he will give the asset back to me on lease, he becomes lesser, I becomes lessee, but the lease is operating lease. Lease is, have I sold it? Have I sold it? Yes. Did I buy it again? No. Operating lease is like rental. So I have actually sold the asset. So there is actually profit. So profit can be transferred to P&L immediately. But what profit? What profit? Fair profit. Now we both are interested parties. I can play with the selling price with him. Why? I'm interested in the next transaction with him. Cost of the asset is 100 lakhs. Can I ask him to give 120? Yeah. If he gives 20 rupees extra, why will he give 20 extra? Next, operating lease is there. No, in that he'll recover extra money from me. Are you getting it? Next case is I can say I want 100 rupees, okay, for the cost of the asset. Fair value is 100. He can say he will pay only 90. I'll be like, no, cost is 100. He's willing to pay 90. I will say, okay, you give me 90. But later when I take operating lease, I will also give less rent. So the next transaction can be adjusted. Are you getting it? So what we do in this case is I have cost price or book value in my books. He is giving me selling price. I will not compare cost price and selling price profit as actual profit. In between, if I would have sold it to some other party, at what price would have I sold? Fair value. I'll consider that. Cost price and fair value difference, what is there? That is actual profit that will be transferred to P&L. Fair value to selling price difference, what is there? That is not actual profit. That will be deferred and amortized over the lease period because that will be affecting our lease payments. I'll repeat. In the case of operating lease, cost price, fair value, difference you take. That you recognize immediately. That you recognize cost price and fair value recognize immediately. Fair value selling price, defer and amortize. Simple. You don't have to see 9 cases. Study material, there are 9 cases. This is more than this is equal to this is less than nothing. Yeah, simple. Cost minus fair value. Profit or loss, book immediately. Fair value and selling price difference. Defer and amortize. Read this. Difference between cost and fair value, recognize immediately to P&L. Difference between fair value and sale value to be deferred and amortized. Only one point. Between fair value and selling price, if it becomes loss, if it becomes loss, don't defer. Why? Conservatism. Book it immediately. That's accounting standard 19.